PayPal announcing a new CEO after this 6-month search, replacing longtime Chief Dan Schulman with an executive from Intuit.
What's up, everyone? It's Scotty with Money Investing. So we need to talk about PayPal, obviously, right? So
PayPal stock. Is PayPal stock headed to $30 a share? Another 50% downside from here.
Guys, PayPal stock was big last week. It was a very popular video for our channel. We got a lot of requests for a follow-up this week.
Welcome, everyone. PayPal.
I'm here today to talk about PayPal stock.
Okay, I think we get the point. A lot of people are talking about PayPal. And it makes sense. When we look at PayPal as a stock, the company is down 20% year to date during a bull market. This has been a good year for the rest of the market, but PayPal's down big. Zooming out the past year, PayPal's down an astounding 40%. And then going out 5 years, PayPal was one of the stocks that had one of the largest climbs in price, going up 300% to over $300 per share. And it's currently down 70% from its highs. What used to be one of the fintech favorites, one of the stocks is talked about with the most hype, the most excitement, has now sold off to a huge extent. In fact, PayPal has traded down so much that now the stock is considered to be the value play, the company that is set up for a significant run. In fact, a lot of people are comparing PayPal today to what Meta did exactly 1 year ago. Remember that Meta similarly had a run up into 2021. Then investors got a little bit spooked because of the metaverse talk. Meta, like PayPal, dropped from its very high price of $400 per share all the way down to $80 per share. And then we can see what happened after that. Meta had a straight line recovery, going up from $100 per share to $200, then all the way to $300 per share. And with the recovery of Meta, a lot of people believe the same will happen to PayPal. So in this video, we're going to be taking a look at the future of PayPal. What is the likely outcome of this stock over the next 5 years? And what I've done is I've put together 3 different scenarios. We have the first scenario where we have the double. This is PayPal's price going up double over the next 3 to 5 years. I map out specifically what needs to happen in the company for this outcome to happen. We also have what I consider to be the base case. This is where everything goes kind of mediocre for PayPal. And we get to see what happens with returns with a mediocre outlook. And then of course we have the bear case. This is where things don't go as well. PayPal doesn't grow quite as fast, margins don't expand, things don't really go as planned, and we get to see the outcome as well. We'll be going over the fundamentals of PayPal, seeing the valuation of it, and seeing the likely outcomes with these 3 different scenarios. So as always, we have a very full video to get into. If you haven't already, make sure you subscribe to the channel. Let's go ahead and jump right in. So let's go ahead and take a look at PayPal on Qualtrim Insights, where we can get a visual look of all of the fundamentals of this company. And we're going to try to get an idea of what this company is, what the history looks like, and that will better gauge our expectations of the future. So let's go ahead and take a look at the quarterly revenue of PayPal. This is since the beginning of it as a publicly traded company, all the way back in 2014. What I see here is a very consistent growing company. I also see one that's having some slight deceleration, meaning over the past 5 years, the revenue growth is 13.57%. So that's very fast, over double-digit revenue growth. But then we have in the past 2 years, it's slowing down to 8%. Then in the past 1 year, down to 7%. So the growth rate has gone in half over the past 5 years. So even though this looks pretty good over time, what we're seeing here is deceleration. When investors see deceleration in revenue growth, you can see the multiples compress a little bit because investors get concerned about future growth. Now, although revenue's great, we want to look at the profitability of PayPal. Not only should it be growing in revenue, it should also be growing profitably. We have many different metrics to look at to measure profitability. The first one we can look at is EBITDA. The purpose of EBITDA is not to give the most perfect example of earnings of a company, but to give a more smooth version of it where you strip out one-time events, you strip out lots of different outlier impacts. For example, you take away the tax impact on a company. So you get to see the earnings of the company with all of these outlier things taken out. And what we see is a company that's growing in earnings over time. Some time periods more than others. For example, over the past 5 years, there really hasn't been a lot of growth in EBITDA. It's gone from earning around 1.3 billion to around 1.5 billion. That's over a 3-year period. So it's been mostly flattish, slight growth since around 2020. We can of course look at the earnings per share. This is the GAAP diluted earnings of the company. Again, what I see here is a company that's had very minimal, if not any growth in its earnings per share since around 2020. So before 2020, the earnings tanked for a couple of quarters, it recovered strongly, and then it's been flat for the past 3 years. The net income of PayPal basically shows us the same thing. In 2020, they had a nice deal of profits there, but there's been no growth over the past 3 years in net income. And a company that's being priced for growth that doesn't grow is a problem. So it makes sense that this one traded down. Now, out of all the different profitability metrics you can look at for a company, I believe strongly that the most important one is the free cash flow. And I've done a lot of work to break up the free cash flow into different segments so we really understand what's going on with the cash flows of this company. The first one that we can look at is the traditional definition of free cash flow. This is the cash from operations minus CapEx. Simple and straightforward, that's all this chart shows. And we get to see it from the beginning of PayPal's history. Going back to the very beginning, it was $325 million, and then it went up to around $500 million. Over time, that grew to $700 million per quarter. We had a couple negative quarters, and then a big one-time spike. I'm not sure why this happened, but I would assume it's an outlier event. That's not a normal quarter. But after that, we get back to a normal quarter. Then we see what happened since around 2018. This is a completely horizontal line. Do we see the problem here? The problem is the cash flows are flat. They're flat on a multi-year basis. When investors invest in a company, especially one that's been priced for substantial growth, they want to see growth in the company. And what PayPal has shown repeatedly, quarter after quarter over the past 4 years, is that they're not growing in their cash flow. They've had some quarters where it was a little bit higher, only to be followed by a quarter a little bit lower. And then overall, the past 5 or 6 quarters have been around the same range of $1 billion to 1.2, 1.7, back to $1 billion, back to $1 billion. This last quarter was negative, but that was because they purchased a buy now, pay later firm. If you take out that one-time outlier event, guess what? PayPal's free cash flow for last quarter looks nearly identical with the past 4 years, still on its long-term track of completely flat free cash flows. Right away, I can see one of the problems with PayPal's story is the lack of economic growth. Now, there's other things that we can look at as well. We can see the dilution they're doing with stock-based compensation. This looks okay. A lot of it is priced in already. Every quarter, they have around 25% of their free cash flow as stock-based comp. When we net that out, every quarter they're making just under $1 billion in free cash flow. So far, PayPal is a mixed bag. It's a company that has decelerating growth, stagnant margins, and stagnant profitability. But the stock price has also dropped down substantially. And one of the ways that a company can grow without really growing is through a low stock price. Let me explain. When you have a stock price that is $300 per share for a company like PayPal, that puts the valuation at an extremely elevated valuation. And if PayPal ever wanted to use the billions of dollars of cash flow they produce every year to buy back the stock at this price, well, that's expensive. That doesn't go a long ways. Paying $300 per share is very pricey. So when the company does buybacks in this area, they're not buying back a lot of shares. It really does not reduce the amount of shares outstanding that quickly, and it doesn't grow their earnings per share that quickly. But now the situation has changed. PayPal's price going down from $300 per share down to $60 per share makes the equation of buybacks far more attractive. This puts PayPal in a unique situation. With a very low stock price and a consistent yet stagnant free cash flow of $1 billion quarter over quarter, they can essentially buy growth. The way that a company buys growth is they buy back their own shares. Buying back their shares at an attractive price reduces the amount of shares outstanding. Because of the attractive price of PayPal right now, they can essentially reduce the amount of shares outstanding by over 4.5% per year with their cash flows. Now, when you subtract 4.5% of the shares per year, that adds up very quickly. Removing all of those shares makes it so that the earnings on a per share basis grow a lot faster. So the more that they can buy back at these low prices, the faster they grow earnings. It also makes it so that the free cash flow per share grows even faster. So essentially, the biggest advantage that PayPal management has right now as a company and as executives is the low stock price. This is the biggest thing working to their advantage. If they're smart, what they will do is scrap every single penny of cash flow and spend it on nothing but buybacks, therefore growing the earnings per share and the free cash flow per share. And that seems to be exactly what they intend on doing. PayPal management has reiterated over and over again, they've emphasized their buyback program. This one is $5 billion that they'll be adding to it, and I'm sure they're going to continue to extend this as they buy back the stock at these low prices. So even though there's some negatives with PayPal, we have static financials, we have decelerating revenue, we also have a massive benefit here. The low price and consistent cash flows can equate to enormous buybacks. So far, looking over the fundamentals and looking at the thesis of the company, I don't think it's too bad. I actually believe that PayPal so far looks like an attractive investment. But what I think we should do at this point is run a couple scenarios. Look at some of the different outcomes that could happen given some different inputs. And what I have here is 3 different scenarios. And here we have the double scenario. Now, I created this on a spreadsheet, but this is actually a tool that I'm going to be implementing into Qualtrim, where we can run different 5-year projections of companies and come up with different scenarios. So what we have here are 4 different metrics. We have the growth of the company, which is revenue growth. We have the margins of the company, which is the EBITDA margin. We have the efficiency of the company. We measure that by the level of CapEx they do. And we have the predictability, which is a measurement of the level of risk of the company. The more predictable the company, the less risky it is. These 4 main factors are the main drivers of valuation for every company. So we break it down into these categories. Then from there, I make a projection over the next 5 years. Now, the reason that I like to do it over 5 years instead of 10 years or 20 years is I feel like when you get out past 5 years, it's very difficult to make projections, and the inputs become very finicky at that point. So I think 5 years is much more predictable, and it gives us a better sense of where we'll be. So this one goes from 2023 up to 2027. So what we have here with this doubling scenario is PayPal growing at a 9% revenue growth. Now, this is something that I believe is entirely possible. PayPal could grow at an average rate of 9% over the next 5 years. The other thing we're assuming here with the margins is that they creep up ever so slightly. They go from 22% to 23%. So far we have decent growth and we have margins going up ever so slightly. We also assume that CapEx will remain roughly the same amount, 2.4% of the total revenue. Now, when companies have growing revenue, they have growing margin, and they're efficiently ran with low amounts of CapEx or at least stable CapEx, that typically makes investors price the company with a higher valuation. At the bottom here, I have what's called a return distribution. And this is based off of the free cash flow yield of the company. The free cash flow yield that's typical for a company like this is anywhere between 2 to 4%. And if PayPal in 2027 traded between a 4% to 2% free cash flow yield, that would be a compound annual growth rate in its total return of 21% to 39%. So to break this down in simple terms, if you invested in PayPal today and the company did have 9% revenue growth, a slight expansion in margins and stable CapEx, and it traded at a 4% free cash flow yield in 2027, your return would be 21% per year, which means that you would turn $10,000 into $25,000. That would be an exceptional return over a 5-year period and would likely widely outperform the market. Now, with all of these assumptions and PayPal traded up to a 3% free cash flow yield, your return would be 28.6% per year, which would turn $10,000 into $35,000. So you would have more than a double in that case. So we can see here the combination of different factors that lead to sizable returns. When you have strong revenue growth, you have margin expansion, and you have multiple expansion, that leads to incredible returns for investors. That is the trifecta, the best thing that can happen to an investment. And this is the ideal situation. This is what PayPal investors are wanting. Now let's go ahead and take a look at another scenario here. I believe this one is a bit more likely, and this would be my base scenario. This is where we're a little bit more conservative with our assumptions. Let's assume instead of 9% revenue growth, that the revenue goes down to 6% per year. So we're above inflation, but still not very strong revenue growth. We're right there with a mediocre company. Then we assume that the margins stay roughly the same. We have no expansion or contraction in margins. And we assume the company has around the same amount of money spent on CapEx. Now we can see the return distribution here. I believe that if PayPal had this type of result, it would trade between a 3 to 5% free cash flow yield. So you'd have returns in this range between 11% per year and 23% per year. Most likely it's going to be somewhere in the middle. Now, this is not the groundbreaking returns of the bull case scenario, but this is still pretty good. You have an attractive investment here if you have 14% returns. So even in a more conservative base case scenario, PayPal looks pretty attractive here. Now, the last case we'll look at here is the bear case. This is where the revenue really slows down. It decelerates down to 3%, so PayPal's having a very tough time growing at all. Then we have EBITDA margins contracting. So instead of being able to grow margins, they have competitors come in, whether it's Apple Pay or Amazon, and they have to lower their take and they lower their margins. So we have revenue growth decelerating, we have margin contraction, and then we also have CapEx investment going up. So they're becoming less efficient over time as well. If this happens to PayPal, the returns will likely be suboptimal. You'll see investors price this company at a low valuation, between a 4 to 6% free cash flow yield, and that causes the returns to go from below 10% to around 9% all the way down to less than 1% per year. PayPal in this scenario would be a value trap. Now, this might seem like it's very negative, and that doesn't seem exciting to say that there's a chance you'll have very, very low returns that will be less than the market, but I actually look at this as a positive, meaning that even if these pretty gloomy assumptions happen to PayPal, where they grow really slowly, they have their margins go down, and they have their efficiency go down, even in that case, they still are positive. You're not losing a lot of money. So overall, given the other two scenarios, the risk reward here doesn't look too bad. Now, of course, there's other possibilities outside of this. There's always a chance that any company gets dramatically disrupted and something terrible happens, but I think that these are the most likely outcomes. I see it overall as a pretty good bet. As for me personally, I'm not going to be investing in PayPal. I do see the attractiveness of the investment and the valuation of it, but my focus is on companies that I think are far more predictable, that already have their financial affairs and growth in order. Companies like MasterCard that grow repeatedly every single year like clockwork. These companies don't need any type of fixing. They already have very robust business models and I believe much stronger moats. So my focus is personally on companies that I consider to be a bit more predictable. But to all you PayPal investors out there, I wish you luck. That's it for this time. I'll see you in the next one.